Hey, countdown. I got to get something fancy like this. Look at that. The lo-fi elevator music.
What do you use for streaming right now?
I'm in OBS, so I guess I can make a scene like this, right?
Oh, okay, yeah. I think it is possible. OBS is good. Yeah, the StreamYard, I saw some other like financial people using it, so I was like, let me try it out.
Oh, this comes standard on StreamYard?
Yeah.
Oh, okay. That's fire. Music and everything?
Well, you have to like input it, but they do have some like standard ones.
Hey, it's macro time. You need to put your own rap over it, too.
Exactly. All right. Welcome, everyone, to the Daily Macro Update, a special Daily Macro Update for Thursday, January 15th. I have a very special guest on today. This is Zachary Foust. I'm sure you guys have seen his viral videos. He's been working hard as of lately to bring you guys some pretty important information. Hopefully, we'll get into some of that here. We'll mostly be goofing off. Just kidding. But there's a lot of important things that are happening right now. It seems like just regular volatility is increasing with all the geopolitical things that are going on, obviously in the past 48 hours for that matter. But also, too, what I appreciate about you, Zach, is you like to pay attention to very similar things that, you know, myself and my team do in terms of like the broader cycle with everything, right? Because everything is ran on debt. That's how the whole entire thing flows. And every 100 or 80 years or so, there seems to be this sort of like reset, right? The last one was back in the 1940s, and yeah, it just seems like every so often we get these big types of events, and it seems like we're inching towards one. But we'll get into all that stuff here. We got Zach. We have him for about 30 minutes here, so we want to respect his time. But if you guys haven't already, go ahead and check out his YouTube, Zachary Foust.
You got it all pulled up. That's fancy. Thank you.
At Zachary Loft is the handle there, and he's got some really good stuff. So I highly recommend you guys check it out here. All right, so I know the last time that we talked a lot about the housing market, which I do want to talk about as well. But you had a decent video about 2026 and kind of how housing prices might stay, or prices in general might stay sticky. So I definitely want to get into that. But first and foremost, man, what is on the top of your mind lately? Like, what has got you jacked up? Like, what are your you're lasered on right now in terms of topics?
I gotta be honest with you. There's a level to it where I gotta almost kind of not treat any event differently than another. You know, you get too riled up and too locked in on every one thing, you're gonna get wish-washed so many different ways with the muzzle velocity of media coming at you.
Right.
I'd say right now, if there's one thing I'm spending a lot of time on, is I'm getting into the depths of the Musk family, the depths of their relations, even past Trump family stuff.
Interesting.
But yeah, it's spurred off of the techno billionaire playground that seems to be getting built in AI super cities like Prospera in Honduras, and how the Pronomos Capital, one of the main backers of that, Peter Thiel and Mark Andreessen, who's an advisor to Trump right now, never voted for a Democrat or supported a Democrat before Trump, which is weird. And then $3 million to him all of a sudden.
The PayPal mafia.
Yeah, paid against, oh my God, the PayPal mafia. And so you have all these people involved, that you got 4 people involved in the direct benefit seat financially or political oversight for this transaction of Greenland. And man, it seems like more, and maybe this is just the internet, maybe I'm completely wrong here, but it seems like almost more and more it's just done in our face. I'm like, you can't do anything about it. Go invest in something. Stock market will go up. Like,
yeah.
I don't know.
Yeah. No, I mean, there's a lot of developments with that right now for sure. And you're definitely more up to date with that than certainly I am, because I'm so squarely focused on the price charts, and I know you are too.
Mhm.
But I guess like in terms of how it relates to financial markets and things like that, we've seen a more of a divergence with this K-shaped economy, right? Where you have the stock market going up, whereas the bottom 50% of the United States is pretty much hurting, right? It's a divergence and a worsening of this K-shaped economy. And so um, from here, I mean, do you think that in and of itself will end up continuing, or will we have that alligator mouth close with some type of event? I mean, obviously, all that is kind of speculation, but really, it's
Right.
like, what is going to fix this? Because it seems like if you just don't own assets, you're just going to be left behind.
No, 100%. That is what it is. It's the rent and be happy plan. I fully believe that. The subscription economy is ahead of us. And holding on to assets that can grow with the weakness of the dollar simultaneously. I mean, I've been yelling about silver and precious metals for about a year and a little over a year now.
Yeah, you've
And
been on top
it's
of that.
it's because it's just the ripple effects. We can clearly see that based off a foundation of knowledge of corruption, so that they want to keep the power in line with who already has the power, keep the money flowing to who already has the money, and that they're going to keep us distracted with culture wars of red and blue so they can chase green. If I can just follow where they're going, it makes me a better investor, honestly. If I can understand the systems that are unraveling, you got silver trust going out over, like you just said, 83 per ounce now. Some are over 90. It's wild to see silver, gold, plumedium, copper, platinum. Yeah, just about to tongue kiss 92. You don't see precious metals trade like meme coins, and the reason for it is, there's a little bit of supply demand. There's definitely some utility in platinum and silver, copper, but largely this has to do with the weakness of the dollar, and the dollar is continuing to weaken. You can look at things like even the Mar-a-Lago Accord. Like, is this planned out? A lot of people would say it is. So I just try to invest with the direction things are going. Like, if the government invests in MP mining and drilling, I'm going to invest in them too, because following the government is usually the most beneficial way, because they're insider trading for a lot of times. I don't know, man. It's, when do we see the alligator mouth shut? Man, the sun could burp out a solar flare and bring us back to the caveman age tomorrow by the end of this podcast, right? I don't know. I don't know. But one thing I've seen consistently and constantly is, as long as they can keep the debt-based economy going, as long as they can keep kicking the can down the road, they're going to keep doing it. So I don't know when that game has to end, but they've consistently and constantly kept doing it.
Right. Yeah, and I think one of my favorite charts that kind of exemplifies all of this is this one right here. And I'm not sure. It's kind of, let me just try and zoom
Yeah,
in
I
a
can
little
I
bit
can
here.
see that. Yeah.
Yeah, this is there's two actually charts. This is one of them. This is the debt to GDP ratio. And, we are at a point right now where it's essentially, well, the last time was COVID, but really the time before that was World War II, when we were at this, near 120% mark, right?
Right.
And last time, the other peaks before that were World War One and the Civil War. The reason
Right.
why I'm bringing this up is because what happens is the entire economy is at a point right now where it's, you could just say fully leveraged historically,
Mm.
right? And previous times, in order to deleverage this, you either have to pay down debt, which obviously the government's never going to do that, or you find a way to shift everything to where you can just inflate things away by devaluing the currency, right? And it's called inflating the debt away. I'm saying that not for you, for the audience, because you obviously know that. But you know, h- my whole question is like, how long can we stay at these levels here? Do we go even higher than this? Or is it just going to be some type of repeat of history where there has to be some type of new agreement that gets
Right.
proposed by major powers? Is it
Right.
something where we shift over from the dollar to something
Well,
else?
the most interesting part about this graph, for me, is clearly and obviously we can see, through the Civil War, World War One, World War Two. Why do we go into those debt spikes? Because of war. And yet here, we see just this consistent and constant raise really since 2010, the post-great financial crisis.
Yeah.
And we've just gone into this unfettered, undisciplined government spending. But one thing I find interesting about this is we do know the solution. We do know the formula because in the late 90s, we actually started to beat it up and we saw that gradual curve down.
Yeah.
But that got hijacked and billionaires and private equity really entered the scene in 2001, 2003. It had a lot more control over the financial system than they had prior. And we see just consistent and constant decisions to inflate assets to weaken our dollar for the sake of investors and donors and corporations. And it's just that we don't see any benefit to the working class. We see wars. We see rumors of wars. We see corporate bailout. We see bank bailout. We got so much problem in the economy. And when you look at red and blue, you can see it on both sides. Reaganomics, that's Republican. NAFTA and Stiegel, that's 90s. That's Clinton. That's Democrat. You got Bush and war and how was that we handled the 01 dot-com bubble and the SEC margin rule change of 04 and Citizens United under Obama. And you walk all the way through it. It's like both sides are slowly and simultaneously strangling the working class. I don't get it because it seems like you don't need, two Harvard brain cells to rub together. I was kicked out of my first semester of community college, right? I'm not learned. I'm not one of the educated. When me and my wife always joke, like when they did those little surveys, like before the campaign, before the election, I should say, and they'd be like, "This is how many people in the uneducated realm would vote," and there were just people that degrees. I'm like, "That's me. Go guys." Uneducated men, right there. That is I. Thank you.
That's right. I'm not as think as you dumb I am.
Exactly, dog. I done learned. The the problem is a lot to do with government spending and this 4 to 8 year. I want to look good in history. I can't let the economy crash on my watch and just throw the Band-Aid on the economy that needs surgery.
Right. Yeah. No, I totally agree. And it's at a point where, and this is something that's, I typically try and hit on at least once a week in some of my content is like, the current administration, the Trump administration, he said it himself, they want rates lowered to 1% or something like that. That's absolutely not going to happen. And if that does happen, inflation is going to go crazy. But the Fed can't cut because inflation is still well above their target, even though it might be trending that way, according to the quote unquote government reported data. But it's like there's still this gridlock between fiscal and monetary policy because you can't go either way. And what I've been trying to do is, obviously, invest accordingly based off of the trends in our own model, but also too, it's like, this sort of thing, just looking back at previous history, hundreds of years, it's obviously not leading up to something that if and when it does happen, you probably wouldn't want to have like a huge amount of exposure to these types of financial assets as they deleverage, right? And
right.
One of the key things that I've been paying attention to is also to the deficit tracker. I'm sure you're familiar with this bipartisan policy.org website. It has a really nice little yearly comparison, fiscal yearly comparison of the government spending, or the deficit rather.
Mm-hmm.
And for those who are joining in the audience here, the deficit is just the amount that you take in taxes minus the money that you have that you spend. You have to borrow the rest to make up for the difference. That's your deficit. And so as you can see, the rate at which this deficit is accelerating here, it has been accelerating over the past few years. It's no surprising that the markets have been accelerating and making new highs because of this. But if we zoom in on this most recent couple months here, compared to 2025, it seems like there is now we need to see at least like 3 months or more in my view. But if this comes in lower, it's no surprising that you're seeing some of these mega caps like Nvidia that has remained nearly flat for the past couple months. And it seems like this this whole entire thing is based off of this deficit rate of change. And like you said, it's like things aren't valuable. It's the dollar that is, it's the denominator that is going down, right?
Right. And the one
Um,
thing about even our own, like our trade deficit, like we saw GDP go up, we saw good GDP numbers, but that's largely anchored on the fact that we had low imports.
right.
So
Exactly.
is it really good? Is that really a good sign? Or is this a move that they're making toward a bigger goal? It's just like, what is it? Is it really, really strategic, super smart people that are operating this? Or is it really people that are just incompetent, ego facing people that are going after themselves and their donors?
I would say the latter rather than the
Yeah.
former.
Right. 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 And it's a matter of whichever one it is. It's just like it's coming at the detriment of the working class and the very people that make this country productive. And we watch things like the stock market, and people claim that it is that it's the economy. And people watch the media and the White House press briefings, and they're like, "Oh, that's what the numbers are." And nobody does research anymore. And it's not fair that nobody's taught economics. No one's taught macroeconomics and how markets intertwine with one another, and how the social aspect and the psychological aspect and the geopolitical aspects get intertwined into it. Like entire tweets can move markets. So it's important that we know that when we look at like consumer spend reports, and we're like, oh yeah, that's great, that we understand that a gigantic chunk is healthcare costs, a humongous chunk, and that our military industrial spend is being worked into these numbers. And there's so many
Mhm.
things that just really don't actually anchor in, is our economy strong or not? It's so many different flags that we wave, and we wave whichever one can be portrayed as the best. And we're just, like I said this the other day, it's like we're not being treated like big kids. We're
Mhm.
being treated like dummies in all aspects. Federal Reserve, big bankers, big corporations, politicians. They just want to keep the game going, right? And that's how I feel. And I'm sure you feel similarly. Of with that knowledge in mind, okay, I can invest accordingly.
Yeah, no, totally. And your channels are doing a really good job with, with letting people know about these things and keeping them informed. And yeah, I remember you called or you were talking about buying silver like what around like $30 or something per
I
ounce or
think
something like that.
my larger buy-in was at 32. I bought
Nice.
more at 50. Yeah, I'll share. I got like probably 75K in it right now, but I only bought 30. So whatever that math works out to.
Nice. I love it. I love it. Yeah, it's pretty wild this move in silver, and as great as it is to be invested in something like this, we also have to look at this as kind of like a broader macro signal. It's like, okay, why is this doing this, right?
Mhm.
And for like the broader type of what does this mean in the macro sense? And so yeah, I think you've nailed it in terms of um, the type of pressure this puts upon the majority of Americans and kind
And the
of
world. In the world, we're 60% of the world's currency. So we
yeah,
have to factor in how other countries feel about us and our dollar.
yeah, no, that's very true. That's very true. And then I guess zooming in on the housing market a little bit because I see things like this that are saying and even the data that's pointing to an acceleration in home sales.
Right.
Not just existing, but I think it's mostly in existing, some new housing, but,
Yeah,
um,
what you got
I
pulled up right now is all existing homes.
yeah, you're right, right. Yeah, I mean, I pretty much just scratched the surface on this stuff, but, I wanted to get your, like, your current thoughts on the housing market and kind of where you're thinking about where it's going potentially in the 2026 year or further than that.
I think of it like Black Friday. I I got to in Delaware, we got one mall that's still living and breathing, does extremely well, the Christiana Mall. And in and around Christmas, Black Friday times, like, man, always packed. I mean,
Mhm.
humongous parking lot. Pack, 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 pack. And it's like, who's running the consumer spend there? Because there's so many people that are struggling. Who's doing it? But this mixture of people overspending what they need and the top 10% really being unencumbered by this economy, the K-shaped economy you brought up, things are fine. Are there some that are struggling? Yeah, but a lot of the higher end products are still moving. Now, here's some context for this. Is yes, December was the highest velocity we've seen in sales in the last 3 Decembers. Just to put context on it. So they say 3-year high. They're comparing it to past Decembers.
Right.
And that's true, but we're also looking at 2024 extremely high rates, 2023 extremely high rates. But look at, yeah, exactly. There you go before that. So in context, look at that number versus the past years, right? So, okay, record high December in the last 3 years. Great. But we're far, far, far from normal. And the normal, to me, I think we're kind of in it for a while of slow frozen markets where investors, boomers, relocators, retirees, those are able to grow their IRA for 20 years, grew their stock market portfolio for 30 years, sat in a home. Like, it's, again, it's just media propaganda. They just want headlines. It's like, guys, can we just be adults about this? This market's not great. I saw the other one the other day. It's like there's more sellers than buyers for the first time in the last 6,000 years, and it's going to crash things. Like, what are you talking about? First of all, your data is using I had to dig into the data because I'm like, this isn't even the number. It said there's 1.9 million sellers. I'm like, there's only 1 million. What are you talking about? And what they factored in was they were using nearly 1 million new construction floor plans as listings. New construction floor plans, which means the builder has posted one of the models they can build. Usually they post like 5 or 6 of the models they can build. They do not exist yet. They have not been physically built, and they won't be built until someone wants them. So we're incorporating improper data to make something look better or worse than it is. And the fact of the matter is, it's not even just a seller problem, because we are getting supply in certain areas, but a lot of it's from new construction. A lot of it's these companies. There you go. A lot of it's these companies that are building homes, and they're too big a home, and they're not in the areas first-time home buyers are needed. And they're not in these labor force areas that are needed, transport heavy areas that are needed. And they're all sitting in Southwest Florida.
Right.
Right.
Yeah.
What you got pulled up here, friend?
Well, this is something that I made. I'm just joking.
Go for it. Claim it.
For those who
For
are
everyone.
joining online here, Zachary has been working hard on this for pretty much over like what, a couple of years now or something, right?
A little over a year. September of last year was the end of the summer campaigning.
Yeah, I think when you were first really going at it was when I had you, and it's improved dramatically since then.
Thank
and
you,
so tying into what we were just talking about here, and I know that we have about like 5 or 8 minutes left.
No, I got 15-minute buffer at the end. We can take it all up, brother. Let's rock.
Okay. What I want to do from here is really get into this tool because, for someone like myself who likes to look at all types of aspects throughout the market, whether that's employment, whether that's liquidity, growth, inflation, and with housing being one of the bigger ones, especially for, affordability and kind of, overall sentiment in the United States, right? Sentiment gauges and housing are pretty much correlated positively. This metric right here does a lot of your Trump tracker here does a lot of the hard lifting on taking all of the different hard data that's out there and pulling it into a single spreadsheet that's for free. And this is something that is like institutional grade, where you could theoretically charge like probably millions of dollars for this thing.
Nah,
right?
you're too kind for that. It's just a Google spreadsheet.
Yes, but it's a powerful one, and it is institutional grade. And so what I would like is for you to, just help me and the audience kind of just walk through the most important things to take away. And like, if you're just looking at this from a glance, like what are the things, as well as the new improvements that you've done recently?
Absolutely. And I'll do that. And I'm going to walk over my computer real quick, and I'm going to unlock one of those tabs temporarily so I can show you something that isn't public on it yet. I'm still working on it.
Oh, awesome.
The affordability index. So we had an affordability score. I upgraded it because now we have data all the way back to 1989. So
Wow.
we've been able to do some cooler things with it.
That's
so
huge.
This is the Trump tracker. I made it after Trump's promises around housing being made more affordable.
Yep.
So this is basically the main 4 indexes around housing specifically, because this was a housing specific document. I've thought about changing this front page to include more of the economic indexes we do now too. But we have supply, affordability, likelihood of a crash, and then overall health. Overall health 49.5. We did start the term at about a 52.1, so it has dropped a little bit, not much, still nowhere close to affordable. Supply critical shortage. Why does it say that when there's homes being built? Well, that's the problem. If we look back at 2008, 2010, when there was about 4.1 million homes on the market, about 500,000 of them were new construction. Okay. Today, if we look at, and we can go to the next tab real quick.
Yep.
Trump tracker document where we can actually see all the numbers built out. And we can zoom out a little bit. So, do you got a roller on your mouse, by the way?
I do.
If you hold control and use the roller, it'll zoom in and out.
I'm a little bit challenged here. Let me see.
You hold control, left control, and then zoom, scroll in and out.
Oh,
yeah, hold control.
I'm on a Mac, so let me see.
Oh, command maybe? I don't know. Either way, Macs are weird. Sorry, I gave you Windows advice. So on this, now I'm getting seasick. If we could zoom in real quick on supply.
I'm gonna figure it out.
Yeah, you're good, dude. If we can zoom in on supply under housing metrics, this is what we're really talking about. He says it's CMD plus or CMD minus. Somebody in the chat said. If we zoom in on supply right there, that's the fifth column down on housing metrics. Yeah. So again, we had about 4.1 million homes. And if we could zoom in just ever so slightly so I could read it a little bit better for those of my friends watching on the phone. Yeah. Okay, that's perfect. So homes for sale. This is huge because every market reacts off supply and demand. This is the core supply metric of housing. So this is what we can look at. The total homes for sale needed is that first column. This is what we need potentially by the end of his term as a realistic number we could get to. So we have 2.5 million that we want to get to. At the start of his term, that's the third column, we had 829,000 homes on the market. As of right now, there are about 976,000 homes on the market. This is down about from 1.01 million as it was last month. So we actually lost supply a little bit, but this is very normal for December. Very normal for December. Right. We'll probably see this number pick back up through spring, summer, as it always does. But it depends on the pace. But the problem with the pace is we broke the supply up into new construction versus resale. So remember earlier I told you at the peak of 08 supply, we had about 4.1 million homes on the market publicly in America, and about 500,000, 508,000, according to the census at that year, were new construction. Right now, it's about half and half. Right now, we're about at the same exact. If you look at the third or second row, you'll see new construction for sale, 488,000. New resale for sale, about 488,000.
Right.
And if you look at the blue column for what we need that 2.5 million, but we need about 2 million of them to be resales. We need velocity. We need a seller to simultaneously be a buyer. We need boomers dying off and exiting the market. We need investors selling off and not becoming a part of the market. We need these types of listings. We don't necessarily need homes that are new construction, especially because they're being built too big. They're being built for too much profit. And they're being built with all the labor and supply upcharges that we're facing, higher rates that we're facing. And the problem about the new construction side is I can't see that number growing too much either. Why? Because land developments of neighborhoods starts 3 years before the first sale. They're buying the land. They're getting the permits. They're getting the regulatory things lined up. They're getting their labor lined up. They're getting their loans lined up. They're getting their financing. They're getting it scoped out, engineers, surveys. They're figuring out where the light poles are going to go, right? They're going back and forth with the county on this specific thing, zoning efforts, right? Do you think there's a lot of gigantic new construction companies just chomping at the bit to buy super expensive land, purchase super expensive labor, higher cost supplies, all financing it at a rate that's higher than it was? I don't think so.
Not here.
And if you don't simultaneously unlock all of this inventory of people that have 2% and 3% mortgages on homes that were $200,000 cheaper, where's the supply going to come from? And that's why I can't dig into this market crash scenario, because around 40%, it's 39.6%, dude. You probably know this. 39.6% of single family homes in America do not even have a mortgage. 33.2% of the homes purchased in Q2 of just this last year, investors. What's going to force them? What's going to squeeze them? I'm not sold. I'm much higher likelihood to agree with you're going to be a renter and you're going to be happy 5-year plan than we're going to have some monster crash in the housing market.
Right. No, I'm totally with you there. And I wanted to also show this in the charts here. This is one of the
is this permits? or builds?
I believe this is builds.
Builds, yeah.
But yeah, I mean, even the stock of these things, right? They're um, it's in a general downtrend, right? You have the
Oh, this is
seasonalities.
their stock. Got it. Got it. Got it.
Yes.
Which
Yep.
this is the build. Is this the first source index?
Believe this is an ETF.
Yeah, but I think it's by first source.
Yes, that's right.
Yeah, 100%. Yeah.
Yep.
And
So,
they got a boost because you're talking about lowering credit card rates. You're talking about kicking out big institutional investors. He continues to talk about regulatory costs. We have freedom cities down the road. So I think these indexes could indeed go up, but will they inevitably build the 4 million homes we need? Heck no. Heck no. They're going to have 20 of their homes sitting on the market not selling, and they're going to pause.
right.
So let me unlock this tab for you real quick.
Yeah, and I think the housing supply thing is really the main issue, and it's definitely structural right now, right? Um, and this freeze that Zach is talking about in the housing market, it's really not going to unlock here unless you have some crazy structural changes, right? Having just boomers starting to sell their homes, and that's who has the majority of the supply right now, and we're just not seeing that. Why would they sell their home? I mean, they probably locked it in for near zero interest rates, and they have that 30-year mortgage locked in. There's no real motivation for them unless like they really have to.
And you have more people than ever that can't afford to buy a home, just barely, and now they're going to the rental market. You can still charge it as a rental. There's so much value in it. Do you see that tab that just appeared for you? Copy of affordability index.
Let's see. Yes.
Should be at the very end. Okay. I'm going to sit over here behind my computer while I do this so I can actually walk through it. So this is actually based off a video that I made about like 8 months ago, 6, 7, 8 months ago. And well, it was winter of last year, whenever that was, like March of last year. Right. So I had this theory. I was like, okay, I need an index to really show how affordable or not affordable a time is.
Right.
And the numbers that I see and the indexes that I see, I don't see a really great one. I think the NAR has a great home affordability index, but it's really tough to track. So here's what we decided to do. In that video, I took all the core costs of living in 2024 because that's all the data we had at that point. Now, This is 2025. So what I did is I created an affordability index based off of the cost of owning a home and raising a young family with the typical needed expenses, right? And you see them here: taxes, internet, phone bill, gas for 2 cars, auto insurance for the cars, family health care, paying the electric bill, food for the family, child care for 1 child, student loan payment for 1 of the people in the home, 2 incomes, 2 used cars for those people, and a monthly mortgage. And I even lowered that mortgage to $1978. That's lower than what a lot of people are going to get today.
Right.
So if you total that all up and then you bring in the median annual income, exactly, you already see it. You got $102,000 you're having to pay per year to raise a young family in America, and you make about $83,730. So that means if the index is supposed to be 100, meaning par, meaning the median income will be about 102.4 to match the 102.4 exactly. Now, if you could scroll over to the right, keep going. There you go. So again, I haven't organized this sheet yet. This is completely raw. So you can scroll down a little bit. I think you can see 2011 too. Yep, 2011 and 2010. Yep. So you can scroll back up, but I want us to be able to see all the years. There you go.
Oh, I see. I gotcha.
Perfect. So the top one's 2024. You can see that was an 82.5. It was getting a little bit better, dropped ever so slightly in 2025. And then if you look at 81, those were both Biden as well, or Biden, end of 2024 or June of 24 was also Biden. My apologies.
Yep.
So the first Trump year, 81, we have 2025. And then next 4, you'll see 2021 was when it started to see that downshift. A lot of us know post-COVID, that's exactly when it started. But the interesting part is, and I don't have it on the sheet yet, but we've done this back to 1998 at this point. The affordability index never really drops below this 96 to 105 marker. It kind of hovers in this range. We've never seen, or at least as far back as I've done the data, to see that there really hasn't been a time, especially consistently year over year over year, where we're in this 80s, low 80s, almost high 70s, when it's really in reality always kind of hovered around 100. You've always been able to make enough to get by. And if we're looking at the country as a business, that's good business. Keep everybody supplied, keep your workers working, keep your laborers laboring, and keep consumers consuming. And right now, what we're seeing, and we're seeing more of this economic unrest, I think this index kind of shows how people feel year over year. And if you kind of attest that score to a feeling economically to those years, at least when I look at it, I see, yeah, that kind of makes sense.
Yeah. No, totally. Wow, man, this is impressive. I've never actually seen a index like this. I mean, they do have affordability indices, but I mean, having it laid out like this and actually putting like um a uh, a score behind it is definitely important. So this is awesome. And you said how far back were you able to get it to
We got
the?
it back on this affordability index back to 89.
Okay,
Or I'm sorry, 98. The total data I have is to 89 right now.
okay, gotcha.
Once
It'd
we
be
hit,
really interesting to see like going back to like the Great Depression
I
and some of
think,
that.
yeah, I think we'll be able to get accurate, consistent data because it's about consistent data back to about 78. I don't know how much farther I'm going to be able to go than that without getting really into some new sources.
Hmm.
But like 78 is probably going to be the barrier, but that will give us Reaganomics. That's
Yeah.
right before we rose the rates to like 19, 20%. We were going
Hmm.
through stagflation. So I think that's going to be a really good base year to see, do we see those 80s in that range too? Because I think we will, maybe even high 70s, to kind
Right.
of comparatively look at when did it feel this way in the past.
Gotcha. Gotcha. Wow. This is amazing, man.
It's cool. It's been cool putting it together. And you're
Yeah.
right. There isn't really an index that takes into consideration just the lifestyle of an American versus what they're typically making. And that's
Yeah.
why I think this kind of does in a simple way. And I wish I could find it's sitting in one of these notebooks, but like I just wrote it out in a little table and then I got in here and then I started talking to whether it was an AI or Google or finding Census Bureau reports and, finding this archive of data that I'm able to use. And, under the Fred Quarterly, I know you can't see it, but I got it locked so no one messes with it. I got just lines and lines and lines and lines and lines of data. It's been a long time to culminate, but as I've been able to culminate it, yeah, I unlock. You're good. You're good. Yeah, perfect. Exactly. Yeah, you can go through it, but you can see. I think that goes back to 1989. There are some indexes that don't track back that far, but the main core items like cost of a home, cost of a car, interest rates, mortgages, grocery carts, healthcare, like not really hard to find those things. And then of course things like internet and telephone cost and telecom stuff falls out as that stuff didn't exist then. There's a objectively right now it looks like 93 to 95 has
Hmm.
the best affordability. But again, I don't have it marked out yet. So I can't wait to see what the numbers look like all the way back and through Reagan.
Yeah. No, this is definitely interesting, man. This is great. Yeah, I'm looking forward to that video here.
Thank you,
And
brother.
yeah, this is awesome. I recommend that everyone go to Zach's link tree.
Yeah, it's in my
If
bio.
you, yeah, it's in his bio. Just go ahead and he has it there for free. You guys can check it out. And yeah, there's also, I mean, we didn't really tap in some of these other things, but just
Right. What
poke.
do you want? What do you want to tap? Which one brings most interest to you?
Well, I mean, everything is interesting to me, but what I really like is that again, you're incorporating more and more data because it's not just the headline data that people should be worried about. Like we need to take that and then dive into the components. And that's
Mhm.
something that I've looked at too is like, okay, you get some type of index or whatever that you see on the headline, but what's the context in which that number is being said? It's kind of
Right.
like how whenever you're talking to somebody, it's not what they say, it's how they say it. It's not what it's not what this government data says, it's what's the context in which it's showing the data, right? What are the components, individual components saying? And you do a really good job with breaking all this down in order to wipe away the fluff type of thing, right? And kind of exposes that. Um, but I guess with this model here, is there anything that you are focusing on, like any type of quadrant in here that you would, I guess, say, for if people want to check this daily or on a monthly basis, whenever it gets updated, what should they go to first?
Well, the dashboard's a really good, easy one to check. We are slowly shifting this into a website. I got some help from the outside that's going to be helping us build this into a mobile facing website. But when you're back
Dude.
on the actual tracker dashboard itself, the main ones that I like to keep an eye on are when it comes to housing, all the housing metrics are up to date and live. It's hard to get all that information quickly on searches. So I've selfishly been able to compact that data together.
Yeah.
I think the affordability by region is really interesting too, to see how the different regions are operating and reacting.
Yeah.
Because there is definitely benefit to being in a place like the Midwest. Even though you'll see red as a negative 2.8, it's only down from being one of the best, most affordable regions in the country. And
Interesting.
while the West is slowly becoming more affordable, the housing tracker is interesting. I think as it's been built out, it's more of a bank crash tracker than a housing crash tracker. But as we can know from history, 1929 and '08, both of those were caused by bank failures. And that's caused by
Right.
liquidity crisis, credit crunches.
Mhm,
With the
mhm.
money we're printing right now, that's a definite sign that we're trying to avoid the bank failure.
Yep.
So, and this number's actually dropped. It was climbing a bit, and then it started to slow back down. Unemployment went from 4.7 to 4.6. There's less homes on the market. We do have that included because more homes means more potential for it. It went down to 0 points as it went under a million. So I'm keeping an eye on it. But I would say as of right now, as we keep printing money, we're throwing band-aids on the economy so that we don't see that bank failure. They don't want to see that.
Right. No, totally. Totally. Yeah. That's 100% correct with
Were you a
even the
part of the
data.
X speeds and the drama around like 3 weeks ago, whether there was a silver short that caused a bank failure that the Fed covered up?
Are you talking about when like they had that spike in
The
in
repo
like
market?
in the balance sheet or whatever?
There was a spike in the repo market, yeah, and then it was for
Mhm.
75 billion. And it was the same time that silver was shooting up, and there was a lot of rumors going around that a heavily leveraged silver company like a JP Morgan or a Bank of America could have actually seen a legitimate crash that was covered up in bond exchanges for cash, covered up in manipulating the silver market. It was going a bunch of different ways. Never confirmed, but these spikes didn't correlate on the reverse repo. So, like, if
Right.
you look at this whole graph of the last 3 months versus the reverse, I mean, there's been a lot more money going out than in. These are
Yep.
24-hour usually loans, but it's for needs of quick liquidity, and it's a signal of bank stress.
Right. Right.
Now it's been flatlined for a bit now. The last couple of weeks been quiet. So I mean, we hope to keep it that way.
Right. Yeah, no, totally. And yeah, I mean, and I know that you and I have been talking about kind of the type of like um quasi QE that they're doing right now. I mean, it is really they are purchasing bonds,
Right. They're just
right?
purchasing short-term bonds. That's how they're
But
avoiding the
yeah, they're
label.
purchasing bills, but still, billions of dollars. I think they dedicated like 200 billion
Uh,
or something
for
to it.
40 billion a month for the guaranteed for the next 3 months, and they'll see about it from there. So annualized would be about just under half trillion.
Exactly. And that all goes back to the, deficits that we were talking about beforehand. And then when you take a look at bond issuance, right? So like this is the paper that the government is supplying and then the Fed is buying it. You can take a look at this here where it's still at extremely high levels. And this is something that I always poke fun at the Treasury Secretary Scott Bessent, because he was criticizing Janet Yellen for doing the exact same thing that he's doing right now, right? There hasn't been theoretically between Biden and Trump, this type of printing at the short end has pretty much been the same, right? There's
Right.
virtually zero difference.
Right. It's and you could see the only times that we did this was in great stress. 2008 we did it for QE1, QE2, a mixture of short and long term. QE3 was mostly long term, QE4 mostly long term, but now with this reverse or with this reserves management thing they're doing, it's largely un under a year. Yeah, under a year, 54 weeks or less. Bonds, we're turning our debt cycle into like a payday loan. And the last time we did this at scale was World War II, and it caused 20% inflation. Like,
Right.
I'm not saying we're going back to that, but it definitely didn't deflate the economy, which
Right.
also isn't a great answer. So what is the answer? It's tough. There's a lot of balancing needs to be done, but we are out of whack, and it's going to
Yep.
smack back. It's going to smack back. It's
Yep.
just a matter of when and how. Like you said, when's the alligator shut its mouth?
Right. Right. Yep. And I think people should be tuning into channels like yours in order to stay up to date with a lot of those things, as well as, yeah, for those who haven't already, go to his bio and make sure you bookmark this and check it out. Looking forward to that website too. Maybe if you're able to code it to have like a widget, I'd love to have it on our website as well.
Oh, yeah, that'd be awesome, dude. It's
But
little by little, we're gonna have to be able to be state by state, term versus term, so we can really lock in and see things for what they are instead of having to listen to all the media.
yeah, yeah. And then also too, as we come to a close here, you've also started a program for people within the Delaware area. If they're looking to, essentially pursue that pursuit of happiness, right? You have the Homefront Fund, correct?
Yeah, that's national actually though. But you're
Oh,
right.
okay. Did
We
you want to talk
created
about that for a sec?
Sure, man. So we created a Patreon and a Venmo. Patreon's $20 a month. We are going to up it, have a 50 and even a $250 tier for those that really want to add to it.
Yeah,
But essentially, what we're going to be doing is we're going to utilize this fund, first picking from those that are a part of the $20 a month, but also being able to just pick people that we think are deserving. Like we had someone on our live today that we're going to be helping pay their rent.
dude,
We're
that's
gonna,
awesome.
yeah, we're going to cover their rent in full for the month, just to give them, a little bit of leeway, a little bit of a financial air. And anybody that buys into the Patreon, $10 of everything that goes in goes toward that fund. Another $5 goes toward operations, so we can keep doing this, and the other five goes to our local food bank. And
Dude.
anybody who's doing more than that, going even deeper, 250 and 100 more of that is actually going to the Homefront Fund. And on top of that, 50% of all money we make on YouTube, TikTok, Facebook, any form of monetization is also going into this fund. So we have a goal set of we can raise, $2,000-3,000 a month and be able to cover, 2-3 people's rents and be able to give back to people that need it most, food in their stomachs, shelter for their family, doing what we can for the people to our left and to our right. That's all we can do at scale.
Dude, that's amazing. Kudos to you, brother. And that's the fruit of the Holy Spirit definitely working through you, man. That's really like
It's a great
what we're
compliment.
supposed to
Thank
do
you
on
for
this earth, because when it all comes down to it, the things that we build need to be spread to the people who we love. And, Zachary here is clearly loving his neighbor just like himself. Well, we praise you, Zach. Thank you so much for
Sounds
coming
good. All
on.
praise to
And
God.
yeah, man, we look forward to seeing you continue to grow and have your success while clearly giving back. And yeah, man, we hope to have you on the channel here again here soon.
Of course, brother. Do you mind if I pray you out?
Sure.
Awesome, brother. Thank you. Dear Lord Jesus, thank you for this opportunity wherever we're tuning in from to have the ability to communicate via this tech platform. Thank you for creating this opportunity for myself and Macroeconomics Daily to be able to give truth and word to the people. Thank you so much for everyone within the sound of my voice. Let your word come through us and not my own. Let my ego be to the side so that yours can shine through. I pray for anybody that's feeling pain, that's feeling darkness, you can shine light on them, that you can put peace within them. And wherever they stay, whatever they believe, that we will love them and focus on your number one command, loving our neighbor, as you've said. In your name we pray, Jesus, Yeshua, amen.
Amen. Praise Jesus. Thank you so much, Zachary, for your time. And until next time, brother. Appreciate
Until
it.
next time, friend.
All right. Bye, everyone.